Something pretty substantial happened today right after the bell. Wells Fargo was hit with an MRA. That stands for Matters Requiring Urgent Attention. And what this is the same notification that was given to SVB days before that bank failed. We'll get into specifically why it's being given to Wells Fargo. This caused a sell-off in after hours, down over 2% at one point, and it's likely not going to be good for markets tomorrow. We're going to get a little bit more clarity on this in the morning tomorrow. Hopefully in the morning tomorrow. Doesn't have to be, but likely we'll get an update in the AM. You also had Mike Wilson, head U.S. strategist at Morgan Stanley, come out and still call for a 20% crash in the stock market. And they are calling for this very soon, as early as this earnings season, which is starting tomorrow with the big banks. So we're going to get into what he said and what is going on with Wells Fargo and ultimately how this could affect your money as well as AMC stock. So let's get into it, guys. Let's start with Wells Fargo because this is not getting a lot of news coverage. And that's for an obvious reason, right? They don't want to spread more panic on this situation. But if you dig into it, it does not sound good. So the headline here says Wells Fargo reportedly scheduled to meet OCC staff at end week, and that is tomorrow. This article was posted today at 4:33 p.m. It came out literally right after the bell. It says, amid the fallout of last month's tumult in the banking sector, Wells Fargo representatives are scheduled to meet with staff from the U.S. Office of the Comptroller of Currency on Friday. I'm not sure if I said that right. The New York Post reported Thursday, citing a federal official. The federal banking regulator was said to have hit Wells Fargo with a number of, quote, matters requiring attention, partly motivated by March's bank failures that focus on concerns of inadequate internal financial controls and oversight of equity and fixed income traders, the article said. So basically risk management seems to be the problem at Wells Fargo. And that's not a good thing. That's ultimately what leads to, banks going under, like SVB, is the lack of risk management. Now, what I find particularly interesting is during the last Fed meeting, when Fed Jerome Powell was answering questions about the banking crisis, he said there's only been a handful of banks that have been served these MRAs, these notifications, basically is what it is. And he did not specify which banks they were and would not say if this banking crisis would get worse. Now, I'm not going to sit here and forecast the fall of Wells Fargo. I'm not going to do that. But it is a possibility, and we have seen crazier things happen in the last couple of years. Now, what they actually say about this, pretty interesting. So if we go ahead and switch to this article, these are literally the only two articles that I can find on this. So if you guys want to check out the description after this video, you guys can read these for yourself or keep these up tomorrow morning. Doesn't matter, but they will be linked down there. Now, it says, the MRAs are specifically focused on concerns of lackluster internal financial controls and the lack of oversight of stock and bond traders, according to the source. So a little bit different verbiage there, right? They are highlighting the bond traders. Now, these MRAs were in part motivated by bank failures earlier this month. After Silicon Valley Bank and Signature went belly up, regulators have had a newfound sense of urgency to ameliorate I've never seen that word in my life, risk. Quote, MRAs are a shot across the bow. Jeffrey Smith, a partner at law firm Voorhees, Satter, Seymour, and Pease told on Monday. It's a regulator's way of putting the bank on notice. If MRAs are not addressed, regulators can turn the heat up quickly, Smith adds. The insider adds that Wells Fargo, headed by CEO Charles Schwab, has already been briefed on the MRAs, but will receive them officially on Friday. Quote, Wells Fargo is the problem child of the banking family, the source told On the Money, and they're misbehaving yet again. The OCC declined to comment. Wells Fargo didn't respond to a request for a comment. Now, if we click right here to the last quote, it says, while today's order addresses a number of consumer abuses, it should not be read as a sign that Wells Fargo has moved past its longstanding problems or that the CFPB's work here is done, Shopper said. So just depending on, you know, the magnitude of this MRA, that's really going to dictate what happens tomorrow. Now, Wells Fargo also does report earnings, so you'll probably get an update, obviously, during the earnings call or with the initial statement, and that is probably going to have a pretty big impact on our markets in general. Now, one would say potentially more bank stress would be a positive thing for technology. After all, that's why the NASDAQ is up 17% so far in 2023, but we don't like to talk about that. I'm just kidding, but it's a crazy rally and it's very unsustainable. But one would say that would mean less Fed tightening, which could be positive for technology. Not really in that camp, but that's kind of where the markets are with it. If bank earnings are good tomorrow, you probably get a sell-off in the markets because the markets are like, hey, there's no reason the Fed needs to U-turn now. It's not like the economy is, you know, going into a recession right now. If we look up the Atlanta Fed GDP Now tracker, you're still expecting very positive GDP numbers. You're still expecting, last I checked, it was like a 2% GDP print for Q1. So like not even close to going negative, not close to recessionary numbers, and we will give that a second to load. For whatever reason, government websites don't like to load very quickly. And right here, as of April 10th was the last update and the last estimate of 2.2% GDP growth for Q1. That is very good. I mean, in the grand scope of people fearing a recession, that's far from a recession. So I think things are going to catch up to the markets faster than people expect. And I think that saying is the chickens are going to come home to roost. I think that is what is unfolding right now in the markets. Now, let's go ahead and take a look at this. Switch gears a little bit because there's only so much we can say until we get new information. I just want you guys to be fully aware of what is going on because, I mean, these are the same notifications that were sent to SVB days before they went under. And just the fear of Wells Fargo going under could cause a mass sell-off in the banking sector as well as the markets like we've seen in March. Now, Morgan Stanley's U.S. stock chief sees more than a 20% downside coming for the S&P 500 and warns of an earnings recession on banking sector turmoil. And he goes on to say that he forecasts a 20% drop later this year amid a looming earnings recession and fallout in the banking sector. Mike Wilson, the Wall Street Giants' U.S. chief equity strategist, reiterated his base case scenario for the S&P 500 to end the year at 3,900, about 6% below current levels. His bear case is 3,600 and his bull case is 4,200. But along the way, he still expects the gauge to hit a trough of 3,000 to 3,300 for the cycle. In S&P 500 terms, if you guys trade the ETF, which most of us are going to, that would be in between 300 and 330 on the SPY. So substantially down there. That would be lower than the October lows. He says, quote, that path to 3,900 still goes through the low 3,000s ultimately, Wilson told Bloomberg TV on Thursday. So this did come out today. Let's see when this article was posted at 4:31 p.m. So again, right after the bell, it looked like you got quite a bit of news. Now, if we do continue on, I really want to read the quotes here. It says, quote, we're in the earnings recession camp. So whether we have an economic recession or not, it isn't as important as the earnings recession, Wilson said. Quote, the earnings situation is way worse than what the consensus thinks. The banking stress only makes us even more confident of that. Now, let's break that down a little bit more. And what is he talking about? Well, if you look at the S&P 500, it's obviously 500 companies in the markets. Well, they get an EPS number. Sometimes it's negative, sometimes it's positive. That is an earnings per share number. That is a raw profits earnings per share number. Vitally important. For the whole entire S&P 500, for 4 quarters of the year, the whole year, you're expecting, or I should say the markets are currently expecting, about $220 of earnings per share. Now, how you figure out where the market should be trading at, or at least do the calculation, very simple. $220 of earnings is what we're expecting, the average consensus for the S&P 500. You go ahead and times this by an 18.5 multiple, and you're at 407 on the S&P 500. So it's all based off of earnings, and this would be 407 on the SPY, and we were there earlier in the trading day today, right? When we first opened for trading, you were around 407, 408. Yesterday, you were right around 407 to close out the trading day. So that's literally where we're trading at right now. 18.5 earnings on $220 of EPS. That is expensive. That's only forecasting like a 3% drop in earnings year over year. Some people say it could be high as 10%. Some people could say it could be more than that. Now, times 220 by 0.90, and that this would be a 10% earnings drop in the S&P 500. That would be 198. Let's say we give it the same multiple as today, 18.5 times. That would be an S&P 500 at 366. That would be roughly $20 higher on the SPY than the lows we seen in October. And if you guys want a visual on this, 366 is right about down here where my cursor is, if you guys can see that, hopefully. That would be a drop roughly of about 11.5% from here. That's if EPS dropped about 10% year over year. And I think that's probably likely at this point, given what we're hearing from Warren Buffett. Granted, what we're hearing from Mike Wilson as well. He is the chief equity strategist at Morgan Stanley. That means he knows how businesses are doing a little bit better than you or I would, because they're in communication with the CEOs, right? Directly in communication with a lot of people that are, big players in the markets, like Tim Cook. He probably has Tim Cook's number. Like, that would not surprise me. So when he is coming out and putting his neck out on the line, you definitely want to be a little bit weary. Now, in that worst case scenario, like he was saying, right? Let's say you still have $198 of EPS for the S&P 500 in 2023. But let's say you give that a more recessionary kind of multiple. Let's give it, well, this isn't a recessionary multiple in history, but in recent history. Recent history, like 2020, and even now, stocks are probably going to trade at a premium just because of inflation. Simply put, probably going to trade a little bit higher than history would suggest heading into a recession. But you give that a 16 times earnings multiple. And that was roughly where the markets were trading at during those October lows. You would be at 316 on the S&P 500. That would be a drop from here of about 23.5%. So this rally that we have really seen from October is not really backed up by anything. Really, all of the backing of this rally is confidence that earnings will come through. If those earnings do not come through, we're going to have a problem on our hands. And even when we get bad news about earnings that might be bad, the markets don't care. Like, for an example, Apple. their MacBooks, their shipments are down 40.5% from Q1 2022 to Q1 2023. You don't think that's going to affect EPS? That would be crazy, right? If that did not affect EPS, you got to look at what Apple is doing with their reporting and their balance sheets at that point, because there's literally no mathematical way that could not affect the bottom line. So he's got some good points here. And that is pretty much all he had to say. Analysts at Goldman Sachs, though I should put this in here, expect U.S. corporate profits to post their biggest decline since the beginning of the COVID-19 pandemic in 2020. So some analysts are even forecasting this, but yet equities and stocks are not expecting it, right? Just based off of how they are trading, they're richly valued, and a lot of people would call it a bubble because you're 2 weeks away from getting large tech earnings reports that are not going to be pretty. And based off of Q1 2023 earnings, it's going to be very clear that companies will not be able to return the profits that investors are valuing them on. So I think that is a big problem. Now, how this relates to AMC, I think it's pretty clear. As of recently, specifically, AMC has been going higher when the markets have been going lower. So on red days in the markets, AMC has been performing very well. This is because there is a major event coming on April 27th. And not to regurgitate all of that to you guys, based off of that, there's a lot of risk right now in being short in AMC. So lenders, call it a JP Morgan or Wells Fargo or Citi, whoever these lenders are that are facilitating these short transactions with these hedge funds and holding the collateral or cash for these hedge funds to stay in these short positions. They're potentially just their brokerages as well. They are going to demand more collateral when AMC does go higher because there's unlimited risk with short positions. And a lot of the collateral here in the markets is with Apple, with Facebook, with Nvidia, with Tesla, Google, and Amazon, your high quality names, because odds of those guys going bankrupt is like you probably have a better chance of winning the lottery of any of those companies going bankrupt in the next 3 to 6 months, right? Or until April 27th. There's literally no way that would happen. If that does happen, I mean, you're in a depression at that point. It's not going to happen. Long story short. So hedge funds, they have to go out and sell stock or pledge more stock for these short positions when the markets do go down. I think that is having a direct correlation and giving you that correlation between AMC rallying as the markets do fall. So ultimately, I do think it could put a lot of pressure on shorts if the markets do start to sell off. Maybe that starts tomorrow. Maybe that starts next week. Maybe it starts with Apple earnings or these other company earnings. Or maybe it doesn't start for another 3 months. Maybe it's Q2 earnings that ultimately have that effect on the markets. And then you get bullishness out of AMC stock. But either way, I think that weakness is coming in earnings. I'm very much in alignment with Mike Wilson here, and I have been from the start. I just don't think there's any way that earnings can hold up to the expectations that the markets currently have. And I don't think inflation is going to come down fast enough to give you 4 rate cuts by the end of this year. So you want to be a little defensive here. There is room for opportunity. I mean, me personally, I bought a new stock today. There's room for you to make money in this market, but you got to be selective. And if you guys want to come trade with me live in real time, link down below in the description of this video. That is a tool as well, never a recommendation, but it is a tool that you can also use, guys. So that is going to do it for this video. Hit that like button, subscribe to the channel, source your comments, questions, or concerns down below in the comment section. Thank you for watching, and I will see you in the next one.